I guess there's not much to say but that. Crazy few days in the markets here. Whenever I went to financial advisor school, I'm sure at some point they told me that I should not wake up on a Monday morning at 3 a.m. and check my phone because when you do that on Monday at 3 a.m. and you see the words global sell-off, it can make the rest of the evening very non-productive. So just wanted to check in when we've seen crazy volatility like this and lots of activity in the news and the markets, just to catch you up on what's happened and where I see things going from here and kind of what's happened to date. So the jobs report came out on Friday. It was a little disappointing. People thought that we were beginning to see a major slowdown in the economy as a result of unemployment going up. Then over the weekend, the news released that Warren Buffett had sold a large position in Apple. It is, I learned later, still his largest position in his portfolio at Berkshire Hathaway. But the news of that then caused many to believe that he either knew something or was on to some sort of important news that wasn't out into the general public's knowledge at this point. And then we had Japan sell off over 12% over the weekend as well. So you combine all of those things, and it came into a very dreary and angry Monday morning. And so what we're learning is the data is being parsed, and we're getting opinions. I've sat in on calls with JP Morgan, BlackRock, Sanctuary had a call, and just been reading across the board on the folks that I trust. And what I believe we're seeing right now is a slowdown, not a recession. And the thing about recessions is, as I've mentioned before, you don't always know you're in them until they're over. So we very well could be, but it feels more like things are beginning to slow down, which we came off of a good first couple quarters of the year. And so a modest slowdown wouldn't be that unexpected. So that then leads us into what's the Fed going to do? If we are in a recession or getting near one, are they going to become aggressive in lowering rates? So Jeremy Siegel was on CNBC this morning, and he said they thought they should do a surprise 75 basis point cut. I seriously doubt they're going to do that. If they were to make a big surprise cut, that could cause a lot of alarm, just like any other kind of shocking thing into the economy where the Fed's saying things are so bad, we've got to inject all of this liquidity via lower rates. And so I don't think they're going to do anything like that. I do think the expectation across the board is that they're going to begin lowering rates. No one knows when or how much. I'll remind everybody in 2023, they expected rate cuts and a recession, and we had neither of those things. So careful of the consensus. It doesn't always give us a clear picture. So these Fed expectations are just that, expectations. How they execute will be interesting to see. And listening to the Chicago Fed president today, I don't see that they're going to react to market things like this or things behind them. They're going to keep looking forward and focus on the data. We also learn when you have a correction like this that if your risk or what you have your money invested in is too concentrated, you can get stung. We've talked a lot about big tech, the Magnificent Seven, over the last couple of years, how the market is so concentrated, and not really much of a surprise then today when stocks began to sell off that those were leaders in some of that sell off. So your Nvidias and Microsoft's, Apple, because of the Buffett news, all of that combined for some pretty large percentage losses. So a couple things just to remind you of though, when you're seeing 1,000 point drop in the Dow, remember that's less than 3%. The Dow has gotten so high that we see these dramatic point moves, and it can feel a lot more alarming than what's actually happening underneath the hood. So while it's still unpleasant, we don't want to see big sell-offs ever and see big numbers like that. In this case, what we saw was just a 3% sell-off, and that's adding to last week. I understand getting us close to correction territory, which would be 10%. I think we've already seen that on the Nasdaq. It leads me to believe that what we're seeing is a natural sell-off or a natural correction. That it's across the board, it's indiscriminate, and that means that people are panic selling. You've got overseas investors selling. You've got program trades where things are having to fill at certain orders. So if Nvidia gets below 100, some hedge fund has to sell it. All that kind of activity can lead on to that. So the other thing, listened today was Marianne at Sanctuary, Marianne Bartels, who's our chief investment strategist, had pretty sanguine thoughts to say this is just a correction. We are likely going to see a good end of the year as we move through the election and some of the noise to equity markets recovering. So I want to leave you with three things just to wrap this up. I think we're slowing, not stopping. the deep recession that's being predicted and or causing a lot of people concern about selling their stocks may not be coming to fruition like many believe, and or not happening now anyway. The economic data will tell us the story, but important to stay invested in a time like this and not panic and not let the news of a deep recession cause you to change plans unless something in your life has changed. The second thing then is that the job competition now might improve productivity. It was for a while anybody that wanted a job could get it. They could get it remote on their terms, demand a salary, and there was actually something going on that I was reading about today called labor hoarding. Companies were paying up and up and up to keep people because it was so hard to get talent. There was just so few job openings that everybody was employed. Well, now that we're moving back to 4% unemployment, people are going to have to start competing again for jobs, which means you get higher qualified candidates. And what I really hope this means is that when I go to a fast food restaurant, I get better service. I don't get some punk that's staring off into space, doesn't know how to take my order. I want to see better service across the whole service industry. And this might be a catalyst for that and more productivity as a result. And then just a reminder that risk concentration it surfaces during these corrections. So this is why we diversify, because if we're overweight too heavily in one area, when there's a correction like this, it can hurt a lot more than it should. We can survive these corrections because we diversify. The other thing I wanted to mention too is that these artificial intelligence companies that are driving a lot of this, they are completely different than the companies that were part of the internet boom in the early 2000s. Those companies were making no money. Nvidia, Apple, Microsoft, Google, these are massive, high revenue producing companies. They're strong. Their corrections are just that, corrections along the way. They're not portending a collapse in the AI ecosystem. That technology is here to stay. It's going to be fractured and ugly and kind of wild west as it evolves and moves on. But the ability for companies to improve their efficiencies and for all the downstream companies that are going to provide these technologies is really, really one of the big growth stories I think we'll be talking about for a long, long time. So everybody, hold out hope. We'll see what happens from here. I'll continue to stay in touch. My phone is ready and available, or we can jump on a Zoom call if you have concerns or you want to review your accounts, whatever the case may be. But definitely want to check in, let you know what I was thinking, what I'm hearing, and we'll see where we go from here. But again, slowing, not stopping. Job competition can improve some productivity, and we want to avoid risk concentration wherever we can. Make it a great week. See you soon.